Hello and welcome to the Savvy CRNA series. I'm your host, Certified Financial Planner Bill McNear with CRNA Financial Planning, where we teach you how to utilize what you've got in order to help you get what you want. In today's portion of the lecture, we want to talk about the basics. What does that mean? The basics, the fundamentals of what? Of freelancing. The first thing that we're going to talk about in our series is the payroll tax. What is it composed of? Who has to pay it? And what exactly does all this stuff mean for me as a freelance CRNA? So let's first start with some definitions. That way when we're having discussions, we can all understand what exactly we're talking about. And we don't get confused using different terminology for different things in casual conversations. The first definition let's talk about are wages. What are wages? Well, wages are actually defined in the Internal Revenue Code, subsection 3121A, and for FICA purposes, which we're going to go over here in just a moment, as remuneration for employment. Simply put, any goods or services that you provide to the marketplace in which you are compensated for are probably going to be considered wages. FICA. What exactly does FICA stand for? You will find throughout this series that the federal government absolutely loves acronyms. FICA, Federal Insurance and Contribution Act. In fact, it's actually a tax composed of two other acronyms or two other components, tax components that we pay as we earn our wages. The first is what's called Old Age Survivor and Disability Insurance, OASDI. You've probably heard it called Social Security. And the other component is the hospital insurance tax. You've probably heard it called Medicare tax. Now these taxes are levied both on the employer and the employee. So just because you're going to freelance doesn't necessarily mean that you're going to get out from under paying some of these taxes. Now the other acronym that we want to go over today is what's called SECA, Self-Employment Contribution Act. Think of that as FICA for the self-employed. Now, what does all this mean as we pull it together? The OASDI, the Social Security, and the hospital tax, the Medicare tax, what do they equal? Well, the grand total of the payroll tax is 15.3%. So if we think through this and we break it down a little bit further, if I'm an employee of another corporation, I have to pay half of the payroll tax, 7.65%. And my employer has to match that and pay an additional 7.65%. So the grand total of the payroll tax is 15.3%. And as you can see, if you work for someone else, you're actually only on the hook or only responsible for half of it. So as with anything else, we have to learn about history. How did we get here? So let's do a quick rundown and see how we actually got to paying all these FICA and SECA and Social Security and Medicare tax. In 1935, President Roosevelt signed into law the Social Security Act. Now remember, this was during the Great Depression. And in 1939, there was a revision. President Roosevelt also signed into legislation which actually established benefits for the survivors of Social Security recipients and the dependents of Social Security recipients. A few years later, in 1956, the concept of disability payments were enacted and signed into law for individuals who may have paid into the system but weren't old enough to collect their Social Security. They may be able to file under disability. In 1972, President Nixon signed into legislation which authorized a cost of living adjustment. You've probably heard the acronym COLA, but in that year it was a whopping 20% in 1 year. Now that's pretty substantial. Now from that point moving forward, Social Security is eligible for a COLA, a cost of living adjustment, automatically each year. Now the government has its own criteria and its own formula in which it figures out how do we increase Social Security. But nonetheless, each year Social Security goes through a process and goes through a calculation to see if there's a cost of living adjustment applied to Social Security and disability recipients. Now in 1983, President Reagan signed into law a provision that would actually include a portion of your Social Security, if you're receiving it, for income tax calculation purposes. What exactly does that mean? That means that the tax that the government has collected on you is used again in the calculations for taxes. So you mean to tell me that the government is actually taxing a tax? It's possible. In 1994, President Clinton signed into law an additional provision that would actually increase that number of what percentage of Social Security benefits would be included for income tax calculations. So there's a brief history, and try to explain to you where we started and how we got to where we are today in regards to the payroll tax. So how really does it affect us? So let's break it down again into another factor tree. Whether it's considered FICA or SECA for self-employed individuals, we all have to pay 2.9% for Medicare, the hospital insurance tax. So let's break that down. Remember, if you work for another corporation or another individual and they are considered your employer, they are responsible for half, 1.45%. You as the employee are responsible for the other half, the other 1.45%. So that's how the government raises revenue, charging 2.9% against wages to pay for Medicare. Now the other component, remember, for the payroll tax is OASDI, better known as what? Social Security. So Social Security is much, much higher, and you'll see that. It's 12.4%. So again, when you work for another individual or another corporation, they're responsible for half, 6.2%. And you, as the employee, you're responsible for the other half, the other 6.2%. So that's the grand total of 12.4, which is how we figure out how much Social Security revenue is going to be raised by the federal government. Now, there is a catch here. Social Security is a larger tax. However, it's only levied against a maximum amount. Now, you may have heard the terminology called the Social Security wage base, which is just the maximum, or think of it as a ceiling, in which wages can be levied the Social Security tax. What do I mean by that? Simply put, if you earn over the Social Security wage base, it would not be subject to Social Security taxation. However, for Medicare, it is unlimited. Well, what does that mean? It means if I earned $1 million in wages, now remember they're considered wages, it's unlimited. I still pay 2.9% for Medicare. At least I pay half and my employer pays half. If you're self-employed, you'd be responsible for all of it. Nonetheless, Social Security has a cap in which they levy their tax. Medicare tax, however, does not. Big takeaway here today, remember FICA or SECA, either one, the grand total is 15.3%. Now, for individuals who are considered high-income earners, as defined by the Patient Protection and Affordable Care Act, there's an additional Medicare tax that's levied on your wages. So if you're single and you earn $200,000 or above, those wages would be levied the additional 0.9% Medicare tax. So your Medicare responsibility would go from 2.9 to 3.8. If you're a married couple filing jointly, and that limit increases, so then now that limit goes from 200 to 250. However, all the income that you earn and file on your income taxes, that's subject to the Medicare tax. It's also subject to the Affordable Care Act additional Medicare tax, the 3.8%. So this is how the government is funding the Patient Protection and Affordable Care Act, especially for individuals who are considered high earners. Now, a few little caveats we have to consider here when we start talking about FICA. Now remember, FICA is what? It's Medicaid, Medicare, 2.9%, and it's Social Security, 12.4%. They're increased each year. So last year, the Social Security wage base, in which they could levy Social Security tax, went up this year. In fact, it went up to $128,400. For Medicare and Medicaid, the 2.9%, there is no ceiling. It does not go away. If you earned $1 million in wages, it would all be subject to the Medicaid, Medicare tax. You still have to pay it. There is no maximum. Social Security, however, remember, is a little bit different. They have a maximum that you have to pay it on. And this year, for 2018, it's $128,400. So all the income you earn between $1 and $128,400 is subject to Social Security tax. And so remember, there's no wage base for Medicare. Never forget that. There is no wage base limit for Medicare. The calculation simply never goes away and does not end. Now that we've gone over some of these definitions and acronyms and factor trees and numbers and what is a CICA tax and what is a FICA tax and what are their components, this would be a fair question, wouldn't it? Is there a way to minimize my tax liability? That's a fair question. Is there a way to minimize my tax liability? Let's dig further. What does the IRS say about the term salary? It says the income must be treated as wages to the extent the amounts are reasonable compensation for the services rendered to the corporation. Okay, let's repeat that. Must be treated as wages to the extent the amounts are reasonable compensation for services rendered to the corporation. Well, what's reasonable? Here in North Carolina, what a CRNA makes may be different than what a CRNA makes in Florida or Washington State or New Hampshire or Massachusetts or Michigan or Texas or California or anywhere else. Those services are going to be a little bit different from state to state, but they have to be reasonable. The IRS tells us so. But in the same breath, they also tell us that there are no specific guidelines for reasonable compensation in the code. Wait a minute. This must be treated as wages to the extent that the amounts are reasonable compensation, but there are no specific guidelines for reasonable compensation. Well, what do we do? Does that give us leeway? Well, I don't know. I think this is an excellent question for your tax professional. What should I do, or what should be considered reasonable compensation in my corporation? Now remember, only wages are considered taxable in regards to the payroll tax. Wages. So is it possible to take money from your corporation that's not considered wages in order to bypass the payroll tax? These are some intriguing questions, and they may be better served if you speak with your tax professional. We're going to touch base on some of these components and some of these definitions in the rest of our lecture series. But first, let me say thank you again for spending some time out of your day to learn with us the mystery of freelancing and how taxes play a major role. And remember, don't wish it were easier, wish you were better. We'll see you in part 2. All right, so here we're going to go over an example of a potential liability with the payroll tax using 2 different assumptions and how we classify income from our business. And so the first scenario is we're going to assume that we have a business income, a net income after expenses, so we'll call it profit, of $200,000. The first scenario, which is probably one of the most common ways, is that we file it as self-employment income or as 1099 income and file it on our Schedule C on our individual income tax return. So let's walk through the calculations. Remember, there's a Social Security wage base. It is indexed and historically has gone up every single year, so maybe next year this number will be higher and the following year will be higher, but for 2018 it is 128.4. So if we take the 128.4, multiply it by the Social Security tax, now remember, you're self-employed, so you wear both hats, the employer and the employee. So we got to levy the entire Social Security tax against the wage base, which is 12.4%. So if we do the math, just our Social Security liability is going to be $15,921.60. And also the other component to the payroll tax is the Medicare and Medicaid. Now, remember, there is no cap for that. So it is unlimited, so no matter what you earn, it is all subject to this tax. So we take the $200,000 for net business income, multiply it by the full part of the Medicare and Medicaid, which is 2.9%. Remember, you wear both hats, you're the employee and the employer. So the calculations come out to $5,800. So I just want you to think about this, and let's put this in perspective. For making $200,000, just your portion of the payroll tax is $21,000. $721.60. Now we're going to have to add federal income tax calculations. Now we may have to add state income tax calculations depending on where you live. And again, depending on where you live, we may have to add a local municipality or township tax on top of the payroll tax that we already have to pay. So you can see that the case sort of builds itself to where it's very intimidating for CRNAs when we start talking about the additional taxes that you're going to have to pay. It can be quite daunting and quite scary. However, let's look at the second scenario where we utilize a particular section of the tax code that might be available to you if you structure things correctly. We have the same net business income. However, we only declared $100,000 of it as salary. So we only took half. Let's run through the calculations again. We take our $100,000 that we declared as salary. Now obviously the $100,000 falls under the Social Security wage base. So all $100,000 is going to be subject to the Social Security tax. Remember, you pay both. 6.2 for the employee, 6.2 for the employer. So now we have $12,400 in our tax liability. Same as said for our Medicare, Medicaid, $100,000 that we declared as salary, multiplied by the Medicare, Medicaid tax, which is 2.9%, 1.45 for both hats, employer, employee, $2,900. So now our grand total for payroll tax is what? $15,300. Look at the difference in the payroll tax by making one small change in how we distribute the income to us as the employees of our company. Rather than paying $21,721, we're only paying $15,300. We save over $6,400 in just the payroll tax alone. This does not include any other potential tax savings that we're going to save. So for the last 2 decades, we've helped CRNAs with calculations and subsequent decisions on how to arrive at particular numbers such as these, and what type of role that it plays when you go through the consideration process of making this decision. Now this is a huge decision, so I would encourage you not to take it lightly. But we have to understand, how did we get here and how are these numbers calculated? So what I'd like to do is invite you to join us for the next part in our series as we discuss how to use this formula and calculate your W-2 wages to a 1099 equivalent and how to compare it and contrast it. So we'll get into that next time on the next part of our series. But until next time, this is Bill McNear saying, don't wish it were easier, wish you were better. Thanks for listening, and we'll talk to you then.